The US Federal Reserve has kept interest rates unchanged but revised its economic projections, igniting concerns about a possible stagflation scenario. Slow growth coupled with persistent inflation. The Fed now expects US GDP to grow just 1.4% in 2025, with inflation staying elevated near 3%, well above its long-standing 2% target. The unemployment rate is projected to rise to 4.5%, indicating stress in the labor market. This shift in outlook has intensified fears of stagflation light, a period of stagnant growth and sticky prices, which could complicate monetary policy decisions. Fed Chair Jerome Powell acknowledged risks from global trade tensions and suggested any rate cuts will depend on clearer signs of slowing inflation. Some FOMC members even hinted that fewer rate cuts may come this year. These developments have had ripple effects in global markets. Indian equities, including the Nifty and Sensex, traded cautiously. Indian IT stocks saw a dip of up to 3.5%. Given their high exposure to the US economy and expected slowdown in client spending. For Indian investors and the Reserve Bank of India, RBI, this presents a dual challenge. While India's domestic demand remains resilient, imported inflation and rising US yields could force the RBI to delay rate easing. Foreign institutional investors, FIIs, may also remain cautious in emerging markets like India if US interest rates remain high. Some analysts believe this period of volatility could present opportunities in US small-cap equities and defensive Indian sectors. However, broader caution prevails until inflation trends stabilize globally. In summary, the Fed's revised outlook and stagflation fears highlight a period of economic fragility in the US, with direct consequences for Indian markets, monetary policy, and investor sentiment.